I'm going to show you the truth about velocity banking and paying down your mortgage faster. First off, does velocity banking work? Yes. Does it work as well as some people may make it out to be? Usually no, but it does have an impact. Now, first off, banks don't care about you. I always say that. And the government doesn't care about you. Government wants to tax you, and the bank wants you to just put some money in their bank so that they can reloan it out and they give you a crummy rate. Or they want you to get a mortgage and charge you interest, a huge amount over time. I'm going to put up a picture here of a video that explains also this method. I'm going to use their example because they made some mistakes. It's not as powerful as they show. I do like their videos. I think they hold the same views that I do, that banks don't really care about you. But let's get into actually how it works. And let me show you the mistakes of that video. And then I'm going to give you an alternative which works pretty much the same, but will give you even more freedom and flexibility. First, in that video, this is what they've assumed, okay? A sale of a home for $150,000, and you put 10% down. So they discuss a mortgage of $135,000. And what does that actually mean? Well, in this case, it's a 30-year mortgage at 7.75%. The total that you would pay on this mortgage over the course of 30 years would be $348,000, significantly more than $135,000. That's why we don't like banks. They're taking a ton from you in terms of how much you're going to pay in interest, because the interest alone, the interest is $213,000. Add that to your principal, that's why you're paying $348,000. So how? You can't get rid of the $135,000. You owe what you owe, but you can try to eliminate this interest as quickly as possible, and that's the whole point. All right, so to give you an idea, the payment is $976 a month. Of that, only $872 goes to interest, and $95 goes to principal. In month 12, only $111 goes to principal. So what does this mean? It means that mortgages are front-loaded. The majority of what you pay goes first to the bank. They're taking almost $900 in interest and the rest to principal. So over the course of 12 months, at roughly $100 a month, you've only paid down your $135,000 by $1,200. That's nothing, right? You've been paying for a year. You've made almost $12,000 in payments, and now you only owe $1,200 less. So you're looking at $133.8. All right. So the whole point of that is that it's slow. One, the bank is charging you a ton of interest. Two, you're paying it off slow at the very beginning. What can you do to fix this? Okay. It's all valid. Now here's what they show in the video, and this is the velocity banking part. So there's three pieces to this. We have here the mortgage of $135,000. We have here in the center, this is a line of credit. Then we have the person's income and expenses. So in this example, they have an income, I'm using the same example they did, of $5,200 every month goes into their bank account. They spend $4,100 a month on expenses, and they're left with $1,100 a month. Okay, so what do they do? Well, since interest is calculated on how much you owe, so if you owe $135,000, interest is calculated on that. If you owe $125,000, it's calculated on that. This is obviously lower, so you'll have less interest. That's why you're going to pay it off faster. The idea is the faster you can reduce that balance, and they're going to do it in big chunks with a line of credit. Let me explain. Go to the bank, you get a $10,000 line of credit. They all work differently, but typically you have a drawdown period, then you have a payback period. And the drawdown period means that you can take money out and use it, and then you can replenish it and put money in. So here's the idea. In month one, the very first thing you do, you got $135,000 owed. You take your $10,000 line of credit that you just got, and you make a payment on your mortgage of $10,000. Now you're still making your monthly of $976, but you've immediately dropped the balance by $10,000. Remember, if you're just making your payments, you're only going to drop the balance by $1,200 in year one. But now, in month one, you've dropped it by 10,000. That's a factor of 10x. What does that do? It means the balance of the mortgage after month one is now calculated at 125,000, which is significantly less. That's the key to the method. But you're thinking, okay, but I just took a $10,000 LOC and line of credit, and I just made an immediate payment. Now I owe $10,000. I can't remember the rate on this. I don't know. Let's just say it was 12% or 14%. The mortgage was 7.75. A fallacy that some people will say is, don't pay off a low interest rate with a high interest rate. Okay, that makes sense if we're talking about the same balance in the same term. But we're not. We're talking about a 30-year versus we're talking about a line of credit of 10,000. This being higher, that being lower, but we're going to pay this guy off super fast. Let me show you how. You take your $5,200 and you move it on to your line of credit. You make a payment. So it's lowering your balance by $5,200. You're thinking, okay, that's great, but now all my money's gone. It is. So you use the line of credit, the expenses are $4,100, to pay your $4,100. All right, so you pay down $5,200, you spend $4,100. What are you left with the balance at the end of month one? You're left at $8,900. Okay, now you keep doing this every month. You move your $5,200, and then you pay out your $4,100, and it keeps going down by about $1,100. And what does that mean? It means that you've made your $10,000 payment and you keep making your mortgage payments. So this is representing right here that you're making mortgage payments. And this is representing you're paying down your line of credit. Okay. Now here's the two mistakes they have in their video. The first is they say that you pay off the line of credit in 6 months. Okay, that is not correct. You're paying it down, as you can see the difference of about $1,100 because you have $1,100 left, so that makes sense. So every month it's going down by about $1,100. That's first thing. You're not paying it off in 6 months. You're paying it off in 10. The other thing is the line of credit does have an interest rate. They didn't add the interest rate back in here. So every month you would be charged interest. Now since you put $5,000 on, the balance is charged on your balance. So your balance will probably be somewhere between $5,000 and $10,000 for month one. Month two, somewhere between $4,000 and $9,000, $3,000 and $8,000. You get the idea. Okay. So it's going to take 10 months to pay this down. What do you do? I'm sorry. So I want to point out that they didn't add the interest in. So it's not going to be paid off in 6. It's going to be paid off in more like 10. So what do? You keep making your mortgage payment for 10 months. And then guess what? You've paid off your line of credit, right? Because you're paying it off at $1,100 a month. Then you take your $10,000, because now you have $10,000 available again. That's how a line of credit works. You pay it down. You can pay, use up to the $10,000. So if you paid it down to 0, well, you have $10,000 available. You take your $10,000 and boom, you make a big lump sum payment. This is just estimating you've taken your 123 down. All of a sudden it drops to 113. You made another $10,000 drop. Huge, right? Because now interest is only calculated on that. So the idea here is simply, this is the velocity banking part. It just means that you're taking and using a line of credit by putting money on it, using it for expenses, and dropping down your balance as quickly as possible. Pay off the line of credit over time, drop it down again. Pay off the line of credit over time, drop it down again. What impact does that have? In their example, the claim is it's going to only take you now 77 months instead of a 30-year mortgage, which is 360 months. That's substantial. And you're only going to pay $37,000 in interest instead of $213,000. Also substantial. But because the math is incorrect, and it's 10 months to pay it off, not 6, and because they forgot the interest, it's not going to be quite this good. Still going to be good, but not quite this good. But what is the one factor that truly made this work? You may already know. It's right in the center of the screen. What made it work was that this person had an extra $1,100 every month that they could put towards the mortgage. Now what the video doesn't say is, you could just take the $1,100 and apply it to the mortgage. Now what would that do? It means that you would make an extra $1,100, which would pay down the principal, but it would be $1,100 per month for 10 months. While this method allowed you to drop the balance by $10,000 immediately. Right? You immediately got to drop it. So it does have a better effect percentage-wise. But now let me show you the difference between this velocity method versus just adding to your monthly payments. Alright, so I went ahead and I wrote the two methods here. The first method we went over was the velocity method, where you use the line of credit, you moved it onto the mortgage, you paid down the line of credit. They had an extra $1,100 every month. So this is the velocity method right here on this side. And the claim was 77 months to pay it off, $37,000 in interest. Because they showed it paid off in 6 months, not 10, and they forgot the interest on the line of credit, it's still good, but not quite this good. Okay, it's close. Now here's the other method you could use. You could just simply take your $1,100 every month and make an extra additional payment. So instead of paying your $976, you're going to add $1,100, $2,076. Okay, so you're simply taking an extra $1,100 and applying it to the mortgage every month. What does that do? It's going to pay it off in 85 months. You're going to pay $42,000 in interest instead of $213,000. Now using the LOC one, it's not going to be quite this good, but it'll still be less. And it's not quite that good, but it'll still probably be less in time. Now why does the LOC method pay things down a little faster? It's because you're able to move $10,000, or however big the LOC is, as a payment and drop the balance immediately. And then for 10 months as you pay it off, you've got a significantly lower balance. The monthly payment will pay down, but instead of $10,000 at once, it's $1,100 per month. You're moving that balance down a little slower. Either way, you're not taking 30 years or 360 months. You're taking somewhere between 77 and 85. And you're not paying $200,000 in interest to the bank. You're paying around $40,000 in interest to the bank. All right. But if you're using the line of credit method, realize that you're tying yourself to those payments. So when you have that line of credit, you need to make payments on the line of credit, right? And then you're going to move the money, make payments and move the money, which means if you don't make the payments, then you're not living up to the terms of that agreement, and that could cause some problems to your credit and otherwise. In the method where you're making an additional monthly payment of your $1,100, if something happens one month, air conditioning unit blows out on the house and you don't have savings to cover it, whatever it may be, car accident, there's a big deductible, you don't have the savings to cover it, and for 1 month you can't make the $1,100 payment. Additional. Well, that's no big deal because you're only obligated to make your $976 mortgage payment. The $1,100 is optional. It's whatever you want to put in. So this method of just making an additional monthly payment, in my opinion, gives you a little more freedom. The velocity method will pay it down slightly faster, but it's also going to tie you up where you have to do certain things. You're going to have a little more freedom with this method. So I wanted to explain the velocity method. I wanted to also compare and contrast and explain that particular video. They did a great job. They just had some little mistakes, but you don't necessarily need to use velocity in order to pay things down faster. Oftentimes the example uses things like an extra $1,100 a month to make one particular method seem it's that much greater. But you got to compare and contrast it to other methods to realize that, well, it's not that much greater. Does it work? Sure. But so do other methods. So thanks for watching. I hope this was helpful. I always try to explain things as simple as possible, but this board got a little messy, but I hope I was able to walk through it in a manner that helps you out. So get out of debt. Don't rely on the government. Don't rely on banks. I appreciate likes and subscribe if you want more of these videos. Thanks for watching.